Hi, everybody. Welcome to today's show, the 7 and 7 show with Zack Ellison. I'm your host, Zack Ellison. And today we have with us one of the best investors out there, Paul Dietrich, who is the chief investment strategist at B. Riley Wealth. And Paul's got a very different view on the markets that has served him really well through multiple cycles. And Paul, I'd love to hear what makes your viewpoints different and also a little bit of your background and how you got here.
It was kind of a weird background in that I was a philosophy major in college, and I was certain that someone would pay me a lot of money to just sit and think every day. And I realized quite quickly I better get a law degree or I was going to starve to death. I also was an elected state representative for 4 years early on in my career, and very involved in presidential politics, and having done largely mergers and acquisitions. That was kind of my lead into investing full time, which I started doing about 25 years ago.
Wow. And you were a lawyer in your previous career and also were a CEO, if I'm not mistaken, of another investment firm. So how did you go from lawyer to an investor to where you are now?
Well, I was early on, right after the Soviet Union fell. I was doing a lot of mergers and acquisitions for large telecom companies and pharmaceutical companies and other companies buying up, businesses in the former Soviet Union. And one of the interesting things about the Soviet Union, you couldn't trust any of their accounting. You couldn't trust anything. So when you were going in to value these companies, you were starting from scratch. And I was representing one kind of very famous investor at that time. And he said, I've got some fairly large amount of money. I'd like you to invest the same way you go and find value in these companies behind the old Soviet Union. And so I did. I started using the same techniques that I use now, and it's been successful for the last 23 years or so.
So you're an expert in business cycles, which I think about a lot. And I think a lot of people don't really understand what that means. So talk a little bit about what business cycles are, what they mean as an investor, and how you might think differently about them than others.
Well, I had an economics professor back in college who said, we make it far more difficult than we need to in investing in the stock market and the economy, because that's what you're doing when you invest in the stock market. It's simply a representation of the real economy, people manufacturing things and selling things and providing services. And he said, it's really quite simple. You have two different cycles, just like we live through a day cycle and a night cycle every 24 hours. We live through a bull market cycle, which usually lasts historically 6 years to 10 years normally. And that a bull market cycle is when the whole economy is growing. Earnings are growing. The stock market is largely going up at its long-term directional trend. And so these are that's what the cycle is. It's hard to lose money over 6 to 10 years when everything is expanding, GDP is expanding, and the market is largely going up. But then, like the day follows night, we basically have these bear market cycles, and they usually last 9 to 18 months, sometimes 2 years. And, what that is the whole economy and the stock market is there. The directional trend is down. Everything is contracting, growth is contracting, GDP is contracting, earnings are contracting, and the market's going down. And, historically, for the last 100 years, the average bear market recession, the S&P 500 index has lost, on average, 36% in each, at a minimum, or in each one of these bear market cycles. And so, it's kind of like playing football. In football, you're either playing offense or you're playing defense, and you have two different teams, two different sets of people. You have different plays for playing offense and defense. And it's a very stupid football coach who thinks he can play his offensive team, all the time, 100% of the time. He's going to lose. And so that's the way I look at it. I have a different playbook for bull markets and a different playbook for bear markets. And it seems to make sense to me. And I've, in each one of, in 2001 and 2, I went on what was then the Financial News Network, which is now CNBC. And I basically said my indicators are showing, and I use leading economic indicators, showing we're going into a recession in early 2001. And, the market, the S&P 500 index, from its peak to the bottom, was down 49% during that recession. I was up about 7% for my clients because I got them out of the market and into bonds. In 2008 and 2009, I went on both Fox Business News and CNBC and said, my indicators are showing we're going into a recession. Got my clients out again. We were down 6%, but the S&P 500 peak to bottom was down 57% during that recession. And so that's how we did it.
Quick interjection. What are some of those leading indicators that you felt were most helpful in making those calls? And what should we be looking at now?
Yeah, there's a group called the Conference Board, and they maintain what the Federal Reserve set up the Conference Board in 1919 when they were created as kind of a research entity. And they look at all the leading economic indicators, and then they put together a composite of those leading economic indicators. Every month, the Conference Board publishes that and publishes the 10 or so leading economic indicators. What they are is the S&P itself is a leading economic indicator, but like new orders, manufacturing new orders would be a leading economic indicator. They go down before you start seeing earnings going down because people aren't even ordering it. We saw it last year when people weren't ordering inventory, which is a leading economic indicator. So somebody at Macy's was saying, I don't think we're going to sell as much this Christmas season. And so we're not even going to order it. So if you look at those, it's not for 7-8 months later that you start seeing earnings were down. Well, you would have known that earnings were going to be down in the fourth quarter of this year, we were down, I think, 4.7% earnings decline. And you would have known that was happening way back in February and March of last year when people just simply weren't ordering new inventory, and new manufacturing was starting to go down. We've had, I think, almost 10 months of new manufacturing orders down. So all of these things are leading economic indicators. And so I watch them very closely. The Conference Board basically has for 100 years basically given a 6 to 9 month signal in advance before we've had a recession. So it's not like you should be surprised.
So in terms of where we are big picture in the cycle, where do you think we head over the next couple of years?
Well, we're right now we're not in a recession yet, but we may be in a recession this quarter. Certainly, we'll be in one by the second and third quarter of this year, and then we've got 6 to 9 months. 9 to 18 months of a recession, and so it's interesting historically. The stock market, being a leading economic indicator, usually bottoms out about 70% through the recession. And so, if you look at if the recession starts at the end of this quarter, the second quarter of the year, that means that the bottom of the market would be sometime at the end of this year or the first quarter of next year. And but the recession may go on for another, into the middle of next year, simply because the bottom usually hits 70% through the recession.
Paul, one thing that I always think about is how the long-term fundamentals really dictate his performance. But over the short term, fundamentals don't really matter. It's more about behavioral psychology. And we've talked a little bit about that offline. Are there behavioral biases that investors exhibit that you think are hurting them now, like recency bias, for instance, or others that maybe they're not thinking about or aware of?
Yeah, this happens all the time. And it's almost a disease in our industry, in that people, especially short-term investors, people who are, trying to buy, the bottom and time the market. I've never found that to be a successful strategy. You're lucky every once in a while, but not over the long term. And especially not when the fundamentals of the underlying economy are changing so dramatically, going from zero interest rates to 5% in a relatively short period of time and keeping them there. I mean, we haven't seen that in 40 years since the Reagan administration, and the 1970s during the Carter administration. And so we're going through some massive fundamental changes in just how the underlying principles of the economy. And so that's one thing. And I think part of the problem is that so many investors are focused on the stock market and stock market indicators. So they're looking at moving averages, and they're looking at price earnings ratios, which, we've seen a decline in earnings in the last quarter of 2002. We're in the first quarter of this year. We're expecting an even larger decline in earnings. We're in an earnings recession right now, and it's projected to go through at least the next 2 or 3 quarters of this year. And so I think that people need to focus on the economy, because you don't have to be a brain surgeon to figure out that things are not going well in the underlying economy. And if things are not going well in the underlying economy, I don't care what happens next week in the stock market. I care what happens long term, where the directional trend is going. And if I know that the directional trend in the stock market is going down, I don't want to be in the stock market, and I don't want to have that kind of exposure, because there is no way that you're not going to lose money for your clients if you think you can be long in the stock market when we're in a directional trend down. It's never happened. All you have to do is look at a history of the S&P 500. The whole definition of a bear market recession is the market's going down, and it's very hard to make money when the whole economy is trending down. And I think looking at stock market indicators and not paying attention to the fundamentals of the economy, they can make stock market investors do all sorts of stupid things.
Agreed. So the question next is, what are the biggest risks that you see and how can we avoid them?
Well, I see fundamental changes taking place. Just, think about the early 1970s, where we had spent massive amounts of money on the Vietnam War and on President Johnson's Great Society spending programs. And we printed all of that money. Guess what happens after you print a huge amount of money and you don't back it up with either increasing taxes or cutting spending? The only way we can deal with that is to devalue the dollar, which we did throughout 10 years of the 1970s. And also in 1973, we had the Arab oil embargo. So we had an energy shock. Does that sound like what we're going through today? We've spent $6 trillion in COVID, $4 trillion under Trump, and $2 trillion under Biden. We have the Russia-Ukraine war, which has changed all the shipping patterns and selling patterns of energy. And so a very similar situation. We added basically 26% to the money supply with that $6 trillion. And the only way, since the Republicans are never going to vote to raise taxes, the Democrats are never going to vote to cut spending, the only way we can deal with this is to devalue the dollar. And we are doing that. It's called inflation. And we are doing that. Probably last year in 2022, we haven't gotten the final figures yet, but with the various inflation, we probably devalued the value of the dollar by 6 or 7% last year. We're probably going to do 5 or 6% at least this year with the dollar, but that doesn't get us to 26%. It's going to take us 5 years of devaluing the dollar. So that's a fundamental change. That affects earnings. All the things I've been reading, everything I could read from biographies of the Fed chairman back in the 70s, Arthur Burns and the Paul Volcker and all of that. And, I could just see everything playing out today, but most people weren't investors in the 70s. You got to be old, like me. I was a young attorney in the Reagan era, and but most people don't remember what it was like. The first home I built had a 17. I bought had a 17% mortgage. So we're going through fundamental changes. I think also with what we learned from COVID, that you can't have just-in-time manufacturing. You can't just have one supply chain source. You need multiple sources. And what that does is it's not going to be as cheap as it was. And so to have part of your supply chain in, say, Mexico or Canada, as well as China, it's going to be more expensive. That means more inflation. And it just changes the fundamentals of everybody's business. And with more reshoring, which I am seeing, where manufacturing is coming back to the United States, or at least the final phase of it, that's going to be more expensive. It's also going to be in some ways less efficient. And so all of these things are happening. Energy is changing. Energy distribution is changing with the war. If we get a war and you ask about what keeps me up at night, in the short term, it's what I believe is a coming collapse in commercial real estate and office buildings, because there's 70%, 60% full, and now they're having to come back and refinance, which in office buildings is done every 5 to 7 years, and they no more 0% or 1% financing. They're going to have to pay more. They have empty space, leases for the office space that's being let go by people because their workers are working from home. Some of them, they're not getting the same amount of money as they got in the past. And we're seeing a lot of building owners just walking in and dropping the keys in the bank. And this is going to affect banks. The banking crisis is not over. Those leases are considered assets of the bank. And a lot of people are believing that we're going to see a 21% default rate. The other thing is China and Taiwan. If that happens, that's a disaster. It will take China into a depression. It will take us certainly into a recession and maybe a depression. It would completely disrupt the world economy. Those are the sort of things. And I think if you had asked me this a few years ago, I wasn't losing any sleep over it. Every analyst I talked to on Wall Street, those are the two things that come up over and over again. And then there are lots of other risks. I haven't seen as many risks in the market even before the last two recessions. They were specific risks, but not the multitude of risks that we face in the market now. And I don't think a lot of businesses have been as transparent, certainly not in the banking business, for that they've got it. Their whole business models have changed over the last 40 years, and nobody realizes it yet.
Paul, do you think the banking system is still at risk?
I don't think it's at risk of collapse, which, we quite frankly had that in 2008 and 2009. The Federal Reserve has come in, and I think big banks are in much better shape than regional banks, smaller banks. But smaller banks make up 70% of the lending, especially for small businesses and local businesses, and a huge percentage of commercial office space in most economies. And, you look, there's some commercial real estate like restaurants and 7-Elevens, they're going to be fine. But all the retail investing they're in bad shape. You go into any town and you see all the retail clothing stores, things like that. They're empty, and there are large percentages of emptiness in all these places. And office buildings specifically they're just a disaster. Right before Easter, we saw 8 big New York buildings where the owners just said, "Have at it. The building is yours," because we can't afford. It makes no sense with what we're getting for rents, with the office buildings, and with rising interest rates, which means higher financing rates for the next 5 to 7 years. They make no sense. The business model makes no sense. And this is all over the United States, especially in office buildings. And then that's going to have an effect because every time a lease goes into default, guess what happens? You try to renegotiate the lease. The owners can't make it. So usually the banks have to eat, that problem. And that's why I don't believe regional banks are going to continue to be in trouble.
So to summarize, inflation, huge problem. It's going to cause a rethink of how everybody does everything. Supply chain issues remain. Commercial real estate, it's a huge risk. Banking, especially regional banks, are at risk. And then, of course, there's geopolitical risk with China and others. So that's a lot. That's a lot to keep.
Yeah. And, a lot of the inflation we're seeing is sticky. We saw it come down, and it will probably continue a bit to come down. But if you look at a chart of core inflation, either the PCE or the CPI, which the Federal Reserve looks at, it's kind of just going sideways. And now with China, Russia and Saudi Arabia pulling back on production, we could see energy prices go up. And I would not be surprised by the end of the summer if we saw inflation going up, not going down. And what's that going to do to the stock market?
So we're running out of time, and I want to leave on a positive note because we've talked a lot about risks and how we're not going to be sleeping much over the next couple of years. In terms of core investment principles that you live by, what do you think is most relevant for today's investor? And then the last question will be what you're most excited about as an investment opportunity going forward.
Well, I always tell my clients that the best money they'll ever make is the money they don't lose in a bear market recession. And I'm a big believer that the mantra of investment managers and financial advisors should be capital preservation. Don't risk the money, the investments that they have, because you know the market's going to be going down. And I just think you either have to hedge or you have to get out of the stock market during these periods of time. And the reason is, and this is the thing they don't tell you on Wall Street, is that it's called the mathematics of loss, that it takes so long to get back to break even after you've lost money in these bear market recessions. I mean, if the market goes down 50%, you have to go up 100% to get back to break even. And the market in general only goes up 10% or so a year. On a compounded basis, it takes you 7-8 years to get back to break even. You don't want that for people's retirement savings. And it's the one thing nobody talks about. And but it's the one really big reality. What I'm most excited about is that I look at leading economic indicators and I follow these business cycles. And we are going to get out of this business cycle sometime, probably early part of next year. And the leading economic indicators will start turning up as they did back in January and February of 2009. The bottom of the market was March 9th, 2009. I was able to get back around June when my indicators showed that we were really starting to move up. And so I was able to get in early. And I know I'll be able to do that again this year because, the underlying economy just doesn't lie. It's either starting to go up again or it's not. And when it does, we'll see all these leading economic indicators going back up. And I'm anxious to get back in early. And after the market bottoms, which as I said, I believe will be sometime late this year, early next year.
That's a good note to leave it on, Paul. Thanks so much for joining today. It's been great having you. I feel like we could talk a lot more. I'd love to learn more about the behavioral side of things. So maybe later this year, we bring you on and talk more about that in depth. So everybody, thanks for listening to the 7 and 7 show with our guest today, Paul Dietrich, the Chief Investment Strategist at B. Riley Wealth. See you next time.